Morning, Daniel.
Good morning, Dan. How are you?
Oh, I'm doing all right. We got coffee. It's a nice weather day. It's a balmy 50 or something. It's almost winter in Colorado.
That's all right. I say it all the time. It's not too bad if you like perfect.
Oh, there you go. I mean, you could almost golf in this, Daniel.
Not almost. I've golfed in colder weather than this before.
You're a braver man than I. So, what are we talking about today?
I want to talk about the role of annuities in financial plans. I think there's something that we hear a lot about also, dividend investing is also something I've been hearing more and more about. And then something called tax-based allocation.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it.
So I think to start it off, I want to start with annuities. Right? Annuities are interesting because it seems like everyone who has one, at least in my opinion, thinks they're the greatest thing of all time in financial services. And anyone who is against it thinks they are the absolute worst thing in financial services. But like everything else in personal finance, right, there is a product for everything. And there is a specific person or situation that the product fits. And it's not that a product is maybe bad or great per se, but more that we run into issues when, we're trying to fit maybe square pegs in circle holes. But, I think when you describe an annuity, some people hear it and they're like, wow, that sounds like the greatest thing ever, right? So I guess first and foremost, like, how would you, very simply, I know there's multiple types and we could get into that, but first and foremost, how do you describe an annuity to someone who hasn't heard of them before?
In the most technical answer, and actually I'll give you the technical answer and then I'll give you what some research suggests we should describe it as. So the technical answer is an annuity is an insurance contract. The insurance contract is specifically insuring against the risk of superannuation, the risk of running out of money in retirement. And so it is an insurance contract that, structured correctly and appropriately, should prevent you from running out of money in retirement by providing you with an inexhaustible stream of income. That's the technical answer. The way that often there's been some studies, there's a whole consortium now of insurance companies that are funded a lot of research on sort of how to pitch, how to share what annuities are. The way that they like to describe them is essentially, would you like to purchase a product or make an investment that will provide you with lifetime income?
Well, I'm not going to lie, Dan, that sounds like a pretty sweet deal. I give someone money and in return they pay me forever? What's the catch here?
I mean, like anything else, it's a product. There has to be a margin and so on. There, as you alluded to, there's a variety of types of annuity. The sort of very traditional annuity is as simple as described. You give an insurance company a lump sum of money, or you make a sequence of payments to them over time, and then at retirement or at a certain point in retirement, you turn on a switch and they start sending you money, and they will do it until you die, or they will do it until you and your spouse die. So there's sort of a basic idea here, but again, it is an investment or an insurance product in this particular case, and of course there has to be some margin in there. And a big portion of how a very traditional annuity, like I just described, works is that you are being pooled together in a risk pool of other people who've purchased this product, and they are using actuarial calculations to essentially juice up your income a little bit greater than you could potentially otherwise provide for yourself, and that's only affordable because of that actuarial analysis in which some participants in that pool are going to die prematurely, which then leaves money behind to help fund additional income for folks who are going to live a little bit longer.
So does that mean that if you live longer, you get more income than somebody who dies earlier every year, or just that since you live longer, you have a longer time horizon for the income to be paid out?
It's more about the time horizon, right? If I live 30 years longer than somebody else in the risk pool, I'm obviously going to get a lot more income, and they're going to get a lot less, and their less is going to fund my more. But this is also sort of the nature of a lot of kind of life expectancy based risk products. Life insurance has a similar function. Part of why life insurance is priced the way it is because you have certain products that will expire before they are ever claimed. Others people will cancel before they reach their life expectancy. So again, there's a whole actuarial basis for a lot of the calculations here, but that's the simple pitch for annuities. As you alluded to, there's a lot of people who have a much more negative view of annuities.
All right, so the inexhaustible stream of income sounds pretty sweet, but as we've talked about already, we fit some square pegs into circle holes here. Where first and foremost do they fit in financial plans? Like, who is this product for? When is it the perfect solution for their plan? But then where is it maybe also misplaced and probably not adequate for somebody's finances?
So in particular, I think there's a couple of specific use cases where annuities are going to make the most sense. Number one, the traditional case I just described. I want to ensure that I have something that guarantees I'm not going to run out of money in retirement, above and beyond, let's say, my Social Security or my para pension or something like that. The second, third, fourth use cases really are going to revolve around more specific circumstances. One, for example, is going to be what's called an investment-only VA. This is an investment-only variable annuity in which essentially you are using the annuity's insurance chassis as a tax hedge, because any investment made into a life insurance product or made into an annuity is not going to be taxed on a going basis. You don't have to worry about short-term, long-term capital gains, dividends, cash flows. So it's a little bit more tax efficient during the accumulation phase. And then often the strategy is going to be to switch from that variable annuity product in the future to a stream of income type annuity product through a 1035 exchange, which is going to be a tax-free exchange of one insurance policy for another. That is going to be a use case for somebody who has maxed out their 401k, maxed out their pension, they've done their backdoor Roth contributions, they really kind of dug out every tax advantage spot they can find, and now they have decided they want to have a longer term investment that they don't need as much liquidity or immediate access to, and in return they're going to use that to go ahead and essentially create more retirement savings for themselves. The other cases, and I said 3 and 4, but I'm just sort of generalizing here. The other cases are going to often be kind of niche specific risk cases. There are certain annuities that are structured with particular riders and benefits, things like multipliers on income if you enter into long-term care, or really kind of juiced up income ratios if you're able to have a certain amount of accumulation or claim the income at a certain point. All of that to just sort of describe and say that a lot of the insurance solutions out there can get pretty complex. And so when you talk about what's the perfect use case, I think there's a lot of fringe and niche use cases where a lot of annuity products can be really useful in very specific circumstances. But it's going to be get into a category where I can't just broadly say like, oh, this type of annuity is great for everybody. There is no annuity that is great for everybody.
Well, I'd assume, correct me if I'm wrong, like it sounds like a really good product or solution for somebody who is close to retirement, who is very wary of market fluctuation, right? Because it kind of provides you with the, I don't want to say guaranteed, but certainty of income for your life, right?
Well, I think there's actually 2 phases here. So I'll give you a good example. There's a variable annuity product type out there where you can pay an additional fee, right? So you're paying an additional expense on top of the existing expenses of that contract to essentially have guaranteed step-ups in the contract value. Where, for example, let's say you're 5 to 10 years out from retirement, you're going, okay, I still want to be invested and whatnot, but I'm a little skittish about seeing the market possibly drop out from under me here in the next, 5 to 10 years. I want to retire in the next 5 to 10 years. So I'm willing to, reduce my upside. I'm going to increase my investment costs by using this product. And in return, this insurance company is going to guarantee that my policy value is going to increase by 5 or 6% every year, even if the market goes down. So that way, as long as my money stays in the policy, and that's a really key kind of criterion here, because this is not going to be a guaranteed return on my money. It's a guarantee from the insurance company about how they will calculate my potential income benefits from this policy. But essentially, I could purchase something like that in the run-up to retirement as I get closer to say, okay, I still want to be invested. I'm really hoping I'm going to have some nice 10, 15, 20% return years, but I'm really worried about a 20, 30, 40% loss. And so I'm going to purchase a type of annuity that at least guarantees that if that happens, I still have some contractual guarantee that I'm not going to have to derive my retirement income from a lower asset base.
So life insurance has a term, right? So I can buy a 10, 20, 30-year term policy. Is an annuity similar where it could be like a term and then after the term's over, it ends? Or this is more like the second you sign on the line that's dotted, you have this thing for the rest of your life?
It really depends on the type of annuity. So, for example, there's what are called multi-year guaranteed annuities, or you'll hear them called MEGAs, just because it's easier to say MEGA. But a MEGA is essentially much more similar to something like a certificate of deposit at your bank. I'm going to buy this annuity contract for 3, 5, 7 years. It's going to have a fixed rate of interest that might be very comparable or even competitive with money market rates or CD rates at the time. And then 3, 5, or 7 years passes on, and I can either roll it into another mega, or I can take my money out and put it somewhere else. So it's, there's certain ones that are sort of time delimited. Many annuities are structured and contractually supposed to be built in either an accumulation way where you're supposed to accumulate up and then they may have an income basis, or you may do that 1035 I described earlier to transfer into another one. Other ones are you buy the contract, your income starts within the next year. These are called single premium immediate annuities, SPIAs. So there's a whole variety here, right? It's sort of, talking about annuities and saying like all annuities are good, all annuities are bad. It's sort of like talking about investment products. You can't really say all investments are good. You can't really say all investments are bad. Some are good, some are bad. And to your point about square pegs and round holes, often the bad reputation of a lot of annuities and annuities in general comes from people trying to force the wrong annuity on the wrong person.
I mean, yeah, I can see a scenario where someone, I'm making this up, by the way. It's like someone is licensed to sell these products and sees somebody who is worried about market fluctuation and sells it as a solution to, hey, well, this thing doesn't fluctuate at all, right? It earns, 6% per year guaranteed. And if you like that, we'll sell it to you. But maybe they're not in retirement and it's a little too conservative. I guess in a situation like that, right, where we're fitting it in the, I guess, a square peg, round hole deal, and it ends, right? So say it's a 6-year term or whatever the thing is, like, can you, after that's over, like say it's in an IRA, can you take it out and then just say, well, I'm done with the annuity thing, didn't like it, I'm going to now just invest? Or is it like when the annuity ends, now that now that it's in an annuity, you have to roll it into a new annuity?
You can get out of the annuity products and go over into other investment products or other investment types out there. The big trick that's going to happen with a lot of annuities is, it's interesting. It's not actually very well hidden, but it is a really big factor in annuities, is that they have often quite significant surrender penalties, similar to life insurance contracts, where if I'm trying to get out of annuity in the first 5 to 10 years, I can often take a pretty substantial haircut in the process. I've seen surrenders as high as 10% on an annuity. So if I bought it and I tried to pull all of my money out or pull more than a permitted amount, often a lot of annuities let you take up to 10% out a year without penalties. But effectively, right, if somebody bought this annuity and then tried to pull it out or move it away, they'd find themselves losing up to 10% or 7%, 5%. And often these surrender schedules decline by 1% a year. So if I have a 7% surrender penalty on day one, next year it'll be 6, next year it'll be 5, next year it'll be 4. And really these surrenders, there's a whole argument about surrender penalties being important for sort of the market function of insurance products to make sure people aren't just sort of like jumping in and jumping out. And there's costs that need to be defrayed for the insurance companies. The basic and honest function of most surrender penalties is just to make sure that the insurance company is able to recoup enough fees or insurance charges to recoup the commission that was paid to the agent who sold the policy in the first place. So there's often a pretty strong alignment between the surrender schedule and the commission rate for that product.
So is the fee the only way that I'll use Lincoln Financial? That's an insurance company. I know it does some annuity products. Like, is that the only way they make money, where I give them, let's say $100,000, they guarantee to pay me out $1,000 for the rest of my life, but now they have my $100,000, right? Like, I'd assume, at least me thinking through it, 1, they get fees. 2, now they have that money, and if they're guaranteeing me that 1% on the $100,000, if they can generate more than 1% with my $100,000, that they make money on the spread, sort of like a bank. Is that also accurate?
That is accurate. And again, it's really going to depend on the structure of the annuities. The trick is, right, most of the companies that are issuing these products have so much capital on hand that realistically, your premiums that you pay in are not going to be the actual source that your income is derived from. Like, a lot of these insurance companies have been around for decades. Some have been around for hundreds of years. And so often some of these companies have such a substantial general account balance that effectively they could fund enormous amounts of income even without new premiums coming in. It's just that their business is to bring that in. You use the word fees here, and I'm sure some insurance listener out there somewhere would insert a very ticky-tack argument that a lot of annuities don't have any fees. You hear this about life insurance products as well. Fees is just a generalized term here. We're not talking about like fees versus fee only versus fee based. We're not getting into how the industry makes its money, etc. When we say fees here, we're just talking about costs. There are insurance product costs that the insurance carrier is either charging explicitly, which could be described as fees, or they're making money on a spread. So certain products might have, let's say, a cap to how much interest you can get out of the product, and then the company gets to keep any interest in excess of that cap. It can be on the cap cash spreads, by reinvesting the premium as you described. There's plenty of ways that these companies make money. Some policies are going to have explicit fees that you'd see on the transactions where they're taking money out of the policy. Others, you will never see the fees, right, or never see the internal costs. But these are not charities. These are all for-profit companies that are making a substantial amount of money doing this business. And I think pretending otherwise is just quite silly as an argument.
Yeah, I mean, I'm a big football guy, and I know a lot of these stadiums are named after, big insurance companies and whatnot. What about commissions? Does like the person who sells me this thing make a commission, and does that come out of, let's use the $100,000 example again. If I put $100,000 into an annuity, does that come out of my pocket? How does that work?
So it's a little bit different than commissions in the investment world. Commissions in the investment world, if you look at something like a Class A mutual fund share, you're looking at typically paying something like 5.75% upfront on the purchase of like the first dollar of a share. And that'll come off the top. You'll actually see that, if I invest $100 in an A share, I will not get $100 invested. I'll get $94.25 invested on the first $100. That's very normal. In the annuity world, there again, sort of the semantic ticky-tack thing where people will be like, well, you don't pay the commissions, the insurance company pays the commissions. Well, okay, money is fungible. If I give the insurance company $100,000 and the insurance company then writes me a check for $7,000, but it came from their general account and not specifically out of this policy, they didn't write me a $7,000 check out of the goodness of their hearts for selling an annuity product, right? And I don't sell annuity products, but just to give you the idea there. So, again, sort of this ticky-tack thing where a lot of agents will say, like, you don't pay me anything. The insurance company pays me. It's like, well, why do they pay you? Well, they pay me because I brought them your money. So, again, you can get really ticky-tack about it, but at the end of the day, yes, almost all insurance products are going to carry commissions. There is a very small marketplace of no commission products out there. And when I say small, I mean, you can probably count these products on both hands, maybe a little bit more at this point. There's a handful of life insurance products. There's a handful of annuity products, but the vast majority of insurance products, both life, annuities, but then all other things, long-term care, disability, home and auto, are commission-based. That's just how the industry has structured the creation and sourcing of these products, and it's how the agents who sell them get paid.
All right. Well, I think that's enough on annuities. I think I get it. And for some folks, sounds like a pretty good deal, but I'm going to try to propose to you a better deal. Dividend investing.
Oh, no.
I'm reading from these anonymous accounts on Twitter, of course, and I'm telling you what, Dan, it sounds like the holy grail of investing. So let me break it down for you. Essentially, it's an investment strategy, right, where I purchase stocks that are specifically in companies that pay dividends. And for those that don't know, think of a dividend as a portion of a company's profits that they pay out to people who own the shares, right? So for an example, I own one share. For that one share, they give me 10 cents. And if I own 100 shares, right, you could start to do the math on the attractiveness of receiving dividends on maybe a quarterly basis. So if I make this, if I have $1 million and I put it all in these dividend paying stocks, I can generate, a sizable amount of income every quarter and every year and use that to essentially subsidize my life, which seems like a pretty good deal. Am I missing something here? Because it seems like investors are drawn to this, and it seems to me like I get to have my cake and eat it too. I'm invested in the market. The stock grows, hopefully, and even if it's a more conservative stock, still hopefully grows, while they're literally paying me to own the stock as long as the company's profitable and keeps the dividend going.
I mean, essentially the appeal of dividend stocks in the way that you're describing is that they have a good story. So let's just take a step back from dividend investing and just talk about like what's actually happening here, right? A company is profitable, as you would hope any company you'd invest in would be. And at the end of the day, right, the executive team, the board of directors has to make a decision. We have profits. We can either retain those profits and reinvest in the company. We can issue those profits out as, dividends, right, payments to the shareholders. And when you think about something, if you scale it down and say like, if I had a small business, I would want my small business to be profitable. And if it was profitable, I would want it to pay me as the owner of the small business. Makes sense. That's the story that makes dividend investing appealing. When you look under the hood of dividend investing, there are a couple of material problems here. Number one, dividend investing or dividends themselves are not terribly tax efficient. And there's a couple of reasons for this. Number one, when a dividend is issued, so let's say I have a stock, the stock is worth $100. When the dividend is issued, let's say of $5, the day that the dividend is issued, the stock doesn't stay being worth $100 because $5 or 5% of the value of that stock is leaving that company and coming to me as a shareholder. So I start, at the beginning of the day with a a single share of stock worth $100. And at the end of the day, assuming the stock doesn't go up or down for any particular reason on that day, I end the day with a stock worth $95 and $5 in cash. There are a couple of tax and kind of cost friction problems here. So we'll talk about this in the context of a taxable investment account first. If I have that dividend is now income that has come to me. It is going to be either ordinary income for an ordinary dividend, meaning I'm going to pay ordinary income tax rates on it, or if it's being paid out of capital that's been held by the company for at least a year, then it'll be treated as a qualified dividend, and then I'll pay capital gains rates on it, which could be preferable to me, but it's still a taxable event. So take the $5. Let's say it's a qualified dividend. Let's say I'm paying a total of 20% capital gains tax. So I started the day with $100 stock. I have $100 in my net worth. Terrific. And at the end of the day, I'm ending with $95 in stock, $5 in cash, and I have to give Uncle Sam one of those $5 in the form of the 20% capital gains tax. So I started the day with $100, and I'm ending the day with $99. Okay, so that is sort of the tax function problem of the hypothesis about dividend investing, and it's an investment philosophy that says I want to find profitable companies that pay their shareholders. Fair enough. But that is not really going to be the best wealth maximizing approach, both for tax reasons and also because dividend paying companies are not always companies that are going to generate the greatest total return.
So let me get this straight. Go back a second here. Let's take AT&T, right? They pay a dividend. If I look at AT&T's stock right now, and I'm not, let's say it's worth $50, are you telling me that every quarter when they declare a dividend, I should see it go from $50 to $49 and then say it grows back to $50 by the next quarter and then back to $49? Or does the price just not really move because it's baked in? Or is it literally declining the day the dividend is declared?
It's literally declining the day the dividend is declared, typically, but it's really actually the issue. So you have the dividend announcement date. You then have what's called the ex-dividend date, which is the date at which, even if you don't hold the stock, you will still receive the dividend. The issuing of the dividend itself is the thing that's going to drive the value of the stock down, because that is the separation of the capital that is baked into the value of the stock, right? The stock is supposed to represent the overall value of the company as well as its future earnings. So then in that sense, right, as soon as that money leaves the company, then the stock will decline. You do sometimes see some irrational market behavior. You see this around stock splits, for example, where people will be like, oh, the stock is splitting. That must mean it's more valuable. We should buy it. It's like, no, it's just splitting because it got too expensive and they wanted to make it a little bit cheaper, unit for unit. It doesn't actually say anything about the health of the company or the value of the company. So there's plenty of people who don't really understand what's happening with dividends or understand what's happening with stock splits who will then buy a company because they think it means something. But all a dividend means is the company had cash and decided to give it out to the shareholders instead of retaining it. That's the end of the story.
Yeah, stock splits are funny. I explained it to someone the other day and said, imagine you go to the store and you buy a pound of ham. Let's say a pound of ham's $10, just for easy numbers here. Imagine the store says, well, $10 is a lot of money. Why don't we just start selling half pounds of ham for $5 because it's a little bit more affordable to people? And then everybody rushes to buy half pounds of ham, or even more people just get 2 half pounds of ham and they say, this is great, this is $5. But in reality, it's literally the same price, right?
Yep. There is no issue with that. There's sort of a sweet spot. A lot of kind of market technical analysts and whatnot think that a stock really should price somewhere between $50 and $100 a share. And if it's less than that, then the stock might be a little bit too cheap. And if it's more than that, the stock might be a little bit too expensive. And not in terms of the value of the company, but just in a per unit basis. It's just, the numbers are getting big or the numbers are getting small, and that sort of affects people's perception of the value. But again, it's just more about the overall market cap, how many shares there are out there. Companies like Apple have done, several stock splits over the years. And then the stock keeps going up to the point where they have to do another split.
So you mentioned dividend investing versus total return. So I guess what you're kind of saying is, let's say on the left we have stock A worth 100, stock B also worth 100. Stock B pays $1 dividend. Now it's a $99 stock with a $1 dividend, essentially. But the total return stock is still 100, essentially, right?
Well, yes, but that's not really the definition of a total return stock. But if you need to continue, please.
No, I'm just visualizing it in my head before I explain it. So what you're really saying is, now moving forward, stock B might get a return of say 3%, but stock A gets a higher return, say 5-6%. It's more beneficial to invest in things that'll have a higher return over time, and then if you need the income, withdraw from the greater the greater pool, the greater portfolio that's had higher returns over time, as opposed to the one that's more conservative because it's not growing as much because they're paying dividends out and receive the more or less inefficient income from the dividends, right? We can just sell, a portion of the higher portfolio, and hopefully recognize those as better gains anyways, better tax gains, than to take it from dividends. Is that kind of what you're referring to here?
I mean, that's the basic argument that's happening. At the end of the day, the question here is not what is going to construct the best outcome for me, right? And the dividend thing we've talked about has some tax inefficiencies, reinvestment inefficiencies, right? If I've got this dividend, now I need to get it reinvested, or it's not going to be earning the same return that it was earning as part of the stock, yada, yada. Total return is just the basic philosophy of, look, it's not really about any particular theme. It's about what is going to produce the best long-term return. The end. That's the conversation. So that's just sort of the baseline that I suggest people really focus on is, if you want to buy investments, including dividend issuing stocks or funds that have a high dividend yield, that's fine, but there is nothing magical or special about dividends. I saw an example once that I thought was just perfect, which was, you have an apple and then a dividend is issued and then a slice is cut out of the apple and you still have the slice, but then if it's taxable, the government takes a bite out of your slice. And so the question is, did you want to have more apple before or after the dividend was issued? So again, there's nothing intrinsically good or bad about dividends, and I think that's just sort of the overriding point here is, they are an indicator of the financial health of the company, that it's profitable enough to issue dividends. The end. If you look at the financial history of some of the strongest performing stocks over the last couple of decades, think your Googles, your Amazons, your Apples, your Microsofts, a lot of them did not or have not issued dividends consistently or regularly, because they have done a better job of growing the value of the company by reinvesting profits into the company, which then drives up the stock price substantially more than the issuing of the dividend would otherwise incur. So, I mean, there's different approaches. There's growth approaches. There's value approaches, dividend approaches, all sorts of stuff. But at the end of the day, there's just nothing magical about dividends. It's just converting equity value into cash.
All right, well, tell me if I found a loophole here. $100 stock, right? Pay a $1 dividend. Stock now worth $99. I have $1. I know you have the option to reinvest the dividend. Can I, in theory, just take my now $99 stock, invest the $1 dividend back in? Boom, now I have, more money and kind of wash that?
You can if you're on a platform that allows for fractional shares, right? Because of like $1 is going to buy you 1/99th of a share of that same stock. So unless I had 100 shares or 99 shares and had enough to then cash to buy a whole share, that's not going to work as effectively. But there's plenty of dividend reinvestment programs and platforms out there. That's not really a big issue here. But one of the things you have to also consider is that there, historically, not really so much anymore. Historically, though, there were commissions on trades and transactions that could be incurred from that. Today, you still have two issues. One is payment for order flow, which is this marginal fraction of cost in the transactions. It's essentially your brokerage accepting money for the execution of the purchase or the sale of a particular share of something. And we're talking about like fractions of a penny per share, so it's very, very nominal. But if I didn't have the dividend happen, and even if this was in an IRA or a Roth or something, I'm still going to lose something from that fractional cost, particularly, the more money I'm trading, the more that cost exists. And then you have regulatory costs. Even though commissions have gone away, the SEC imposes a cost on essentially all trading transactions. It's very, very nominal. I think right now it's like $22 per $1 million traded. So again, super, super fractional. But every transaction is incurring some degree of cost that has to be accounted for in the aggregation of whether we're making more money or losing more money to these exchanges.
Mm-hmm. And correct me if I'm wrong, even if you do, let's use a taxable account here, even if you do reinvest the dividend, it is still taxable in the year you receive it. Is that correct?
Correct. So bearing in mind, right, that, again, that's a taxable event. That issuing of profit to you creates a taxable event where previously in the, unrealized gain or growth of the stock, there was no taxable event.
Bummer. All right, well, what about, just lastly here, we were talking a lot about taxable accounts. How do dividends work in, say, a Roth account in which I've already paid taxes or a pre-tax account in which I'm deferring them?
So we're not going to have to worry about the tax drag on those. That's the nice news. The bad news is you still have those potential transactional costs that are going to come from reinvesting.
Okay, so if it's a pre-tax account, when I withdraw the money, I'd assume I just pay, tax on the dividends that I withdraw at that point in time. And if it's a Roth account, I don't actually pay tax on at all on the dividend.
Yeah, the pre-tax IRA, pre-tax 401k, whatever it is complete, does not care about the nature of the investment gains or taxable events that happens inside of it. It just treats all distributions out of that account into your normal checking, your normal savings, right, your spending accounts as taxable income, and it does not care from whence that income comes or what the derived source of the returns was. With the Roth, there are no taxes. We don't worry about it at all.
So I know we invest in things that do sometimes do spit out dividends, right? And probably just reinvest them for the most part. But is there anywhere where a dividend strategy by itself actually fits in someone's plan? Or is it more just a side benefit to investing in something that has a dividend?
This is going to be maybe a little bit more controversial. I don't think there's actually a place where dividend investing makes intrinsic sense at all. And I say that in the sense that I'm not saying dividends are bad. I'm not saying there's anything wrong with dividend issuing companies. I'm not saying there's anything wrong with investing in them. But if your intention is, I'm going to buy dividend issuing investments, and then my intent here is to live off of the income that generates, right? I'm anticipating that they're going to keep paying out dividends every month, every quarter, twice a year, whatever tempo that I'm buying into. These are not bonds. These are not fixed income instruments where I have a contractual guarantee of coupon payments or of a fixed return or growth in the value, so on and so forth. There has been an enormous amount over the years of people who have gotten suckered into buying preferred stocks, right, which are stocks that are not common stock ownership of a company, but they are essentially shares that sell at particularly fixed prices and then are essentially guaranteed to receive profits or shares of profit before the common shareholders do. And a lot of people have lost their shirt on that because even though they're guaranteed to receive, let's say 6% of anything before it comes out of the company, well, that's great. But then if the value of the preferred shares tanks because the company is not profitable, yes, you're receiving income assuming that they issue dividends, which is not a guarantee. But also then we return to the total return thing. Like if I buy a bunch of stocks on the premise that I'm going to get, let's say, $50,000 of income off of them every year because I've got a 5% yield on $1 million portfolio, well, that's lovely. But if the stocks that I bought to generate that yield sink by 20 or 30% in value, I am way poorer for that decision. So again, it's something where dividends are just part of investments, and I don't think they are intrinsically valuable enough or important enough to become the sole focus of why you would make an investment.
Yeah, I think that's fair. All right, so total return over dividend investing is kind of what it sounds like we're getting at here, which I think leads nicely into the third topic, which I was kind of trying to allude to with the dividends in either like a pre-tax account or a Roth account, which is essentially this concept or strategy of tax-based allocation. So essentially, correct me if I'm wrong, thinking like a strategy where we place different investments and different assumed returns that we'll get for these investments into specific accounts that have different tax consequences and to potentially boost, say, after-tax returns, reduce the tax burden while still having the same overall desired asset allocation. So, for example, right, municipal bonds already have tax advantages, so it's probably not wise to put them in a Roth where we've already paid the taxes, right?
I mean, as a good example of that, but also just because you buy municipal bonds specifically based on the net of tax-adjusted yield, because all things being equal, they will always pay a lower coupon than a comparably credit-rated private bond or corporate bond.
And for another example, put things that have more maybe growth potential, things we assume, like if we're 70% stocks, 30% bonds, put the stocks for the most part in something like a Roth because we've already paid the taxes. So if it grows 50%, we're not paying gains on that. Comparably, if we put that instead in, say, like a taxable account, we're going to owe the gains on that. That's kind of how I think a tax-based allocation. Is that more or less kind of the gist there?
Yeah, I mean, you've got the basic idea here, and functionally, I think this is where you can get into sort of the argument about really trying to pick up pennies in front of the steamroller. The basic idea here is you've got pre-tax accounts, you've got Roth accounts, you've got non-retirement accounts, and the idea here is, well, if I only allocate certain investments to each type of account, that is optimally the best place for that type of investment to be. That can be good and bad. I think that the basic argument here is pretty obvious. It's the more tax efficient. So putting your growth stocks in your taxable account or in your Roth because they are not going to issue a lot of dividends or have a lot of taxable events, and that's going to reduce tax drag. Putting it in the Roth because we're going to just see the highest appreciation there, and that's the most tax-free money, and that's great. In turn, maybe you're going going to say, let's put all of our bonds, our fixed income instruments in our pre-tax IRA. So that way, A, we don't pay any taxes on the accumulating interest when the interest happens, reducing the accumulated tax drag. But also in doing that, we can also take the approach then that, that's also going to increase the overall value of the pre-tax account less, and therefore we're going to have less potential taxes due in the future when we reach our required minimum distributions or reach retirement. All of that is fine. I think the key downside to this can be asset allocation and risk problems, because most people don't have perfectly equal contributions to their Roth accounts and their pre-tax accounts and their taxable accounts, and they're probably not going to adjust their contributions to those accounts in the future based on which accounts are leading and which accounts are lagging. And so that can result in an aggregate portfolio problem where we have a lot of tax efficiency here, like we're accomplishing that goal, but maybe we have all of our growth stocks in the Roth, all of our growth stocks in the taxable account, and then we have all of our more dividend heavy or interest heavy assets in our pre-tax account. Well, long-term left to its own devices, what's going to happen? I'm going to have a large Roth. I'm going to have a large taxable account with a lot of baked-in long-term capital gains. And in turn, I'm going to have most of my low-value or high cash-yielding investments in my pre-tax account. And that's going to create an environment where if I want to rebalance that risk, I don't have a lot of levers to push and pull here that aren't going to result in either incurring a lot of taxes or derailing that strategy at some point where I go like, well, gosh, I started with, let's say, an 80-20 portfolio. I've been doing this for 10 years, and now I've got a 95-5 portfolio because the growth stuff has been ripping. The fixed income stuff has been piddly. And now I want to get back to an 80-20, or I want to de-risk down to a 70-30, but I can't get enough money into my pre-tax accounts to accomplish that. So I'm either going to have to substantially adjust the asset allocation of my Roth to accomplish this, or I'm going to have to incur a bunch of taxes in my taxable account to accomplish this. So, again, it creates tax efficiencies at the cost of making your aggregate portfolio management a little more complicated and a little more challenging.
Yeah, those were my main two thoughts when I was thinking about this topic. Was one, it's a case of over-optimization, I think, but really, I've never really seen somebody who has a mix of, say, 33% pre-tax accounts, 33% Roth accounts, and then 33% taxable accounts, which gives us this neat kind of aggregation where we can probably, make this arbitrage a little bit easier. More likely than not, someone's got $1 million in pre-tax, $200,000 in Roth, and $100,000 in taxable, which kind of just makes this a little bit more difficult. In a perfect scenario, right, that wouldn't be the case, and you'd be able to do something like this. But then the second part is kind of like you said, right? Over time, those aren't going to be 33, and 33%. One will grow to 50, the other will be 20, and that one's 30, and now you have to kind of reconcile the differences, which kind of, I think it sounds really great on paper when I say it, right? Put the risky stuff in the accounts we've already paid the taxes on or in the taxable account, put the more conservative things in the pre-tax accounts, etc. But it kind of just feels like one of those things that sounds great on paper, but in reality is just really, really hard to actually do.
Well, and getting it started is easy. It's the ongoing maintenance that's a challenge. And I think this is something where a financial planner or an professional investment manager can, earn their living a little bit, right? You can outsource this to them. They can do this for you. They're going to have more tools and reports and so on to kind of help work through this. I think this is something that becomes very tedious for your everyday investor to do, particularly if it's not their full-time job or they don't have sort of the requisite tools and so on to make it a little bit easier on themselves. So it's just something where, again, you can pick up pennies in front of the steamroller, but at some point you might get exhausted and get run over by the steamroller. So it's just something where you need to approach this particular subject with an awareness of the effort required and an abundance of caution about the long-term ramifications of getting it wrong.
Yeah, I think that's well put. I mean, like you said, it's probably easy to implement at first, but the ongoing maintenance required makes it really difficult, and the best investment strategy is one that you can stick with for the long term, right? So if it's not something you are going to commit to doing on a monthly basis or quarterly basis or however frequently you decide to rebalance said accounts, it's probably just not sustainable.
I think also, and back to the pennies thing here, I think it makes more and more sense when the numbers get a lot bigger. But if I'm 25 and I've got $20,000 saved up, I don't think this is the sort of thing that's a good use of your time. You're better off working on building up your human capital, your earnings potential, and just making more money. But, again, I think it's a strategy that starts to make a lot more sense with a lot more capital. If I've got $50 million and I'm potentially staring down a several $100,000 annual tax bill due to inefficiencies, I can see a better case for wanting to be a little bit more efficient about this. But for the everyday person, even if you're 40, 50, you've saved up $500,000, $1 million, you can get something out of this. But I don't know that it's the thing I would run to first, particularly when there's a lot of other lower hanging fruit.
Well, can you do it like in a controlled, maybe like micro way? So for example, right, like we're not putting the muni bonds in something like a Roth account, and maybe like here and there making some efficiencies from a tax perspective as opposed to making it the overall strategy.
I mean, sure. You keep using this example of not putting munis in a Roth, but I just want to be super clear to anybody here. If you put municipal bonds in any retirement account, you are committing malpractice. And somebody out there is going to be like, well, there's a couple muni bonds out there with a really great yield that makes sense. Go find the corporate equivalents that'll have a better yield for the same risk-reward profile. That is, again, how they work. And for anybody who's not really aware of how these work, I'm just going to say it real quickly. Municipal bonds pay lower interest rates because if it's issued in your state of residence, you don't have to pay federal or state income tax on the interest payments that come to you, and therefore that creates a net of tax yield that is perhaps equivalent to a 30 or 40% premium depending on your tax rates. They're great for super high earners, high tax people who in high tax brackets. They're great in states like New York and California where you just get absolutely raked over the coals with taxes. They're not so great in a place like Texas where you only have federal taxes and no income tax. Mm-hmm. So it's just something where, again, it doesn't make any sense in a retirement account because there is no net of tax yield. There's just yield in a retirement account.
Yeah, I saw it once. That's why I'm sticking to it. At my last firm, it wasn't someone that we worked with. It was someone that came to work with us from a previous firm. Had that situation, and it irked me. So.
Yeah, I would say irked understates.
Yeah.
Anytime I see it, I immediately lose any and all respect for the counterparty.
Mm-hmm.
Just because, again, the most common place I see this is big bank wirehouse type firms, and the advisor or the broker in the branch is just sticking them into a TAMP or a separately managed account that some other firm or some other department of the bank operates for them, and they're not even bothering to recognize that municipal bonds don't belong in this $1 million IRA, and it just pisses me off every time.
How did you know?
It's almost like we see the same bad actors do the same bad things over and over and over again.
All right, well, cool. Thanks for dispelling some of those myths or misconceptions I might have had about some of these strategies. I think some really good information here.
Yeah, I mean, at the end of the day, investing is complicated. You want to try to keep it simple for yourself. If you know what you're doing, great. If you don't, work with somebody. But you can waste a lot of time and a lot of energy and get a lot of gray hairs chasing, tiny yield improvements or tiny value adds that really just don't equate out to the effort required to attain them. So just be mindful of it. But with that, let's go ahead and hop on to my favorite question of every week. Daniel, what is it that you've learned this week that you want to share with our audience?
Don't play like short-term games with long-term money or long-term games with short-term money. I feel like every week I get on this thing and I'm like, oh, I have a buddy, and I describe a situation. People might think like my friends are all financially illiterate and I'm not teaching them anything, which is not the case. But I do have a buddy who was saving up for an engagement ring, and this was a couple of years ago, and he was like really adamant. And this was, I think I was still in college at the time, but like his whole family, everybody gets married very early, and he was already at that point in time starting to save for this expense. And his big thing was he wanted to put it, the money he was saving in like a risky stock and say, well, if it goes up, right, like now I've doubled the money I have for my engagement ring. And that's all he could think about was like the upside. And funny enough, he reaches out to me a couple of months ago. So it's not really something I've learned this week, but it kind of came up this week from just the way I was thinking about it. Lo and behold, the stock is like 75% worth of what it was a couple years ago. And it's like, cool. You played long-term games with short-term money, meaning that you don't have the long-term time horizon for this thing to recover. So if it, say in 5-10 years it doubles and it recoups what it lost, that's fine, great. But he doesn't have a long-term. He's playing long-term games with money that is designated for the short term, and because of that, his soon-to-be wife will probably get a less than a lesser ring because of it. And that could have been easily avoided. I think it's very alluring in the short term to think, well, if I double my money, that's great. But like, if you have a $10,000 for a ring, right, and something returns 20%, great. That's an extra $2,000 net of tax, probably $1,600, right? Like, so honestly, not that much more. But on the downside, if it loses 20%, now you have $8,000, and it's an incremental gain for what's a considerably more significant loss on the downside for short-term things. And this can be buying a ring, it could be saving for a down payment on a home, or maybe your son or daughter is 5 years away from college and you decide to bet it all on red in Vegas. But like we see that a lot, people that want to play short-term games with long-term money, or conversely long-term games with short-term money, and we lose either way.
Yeah, and at the end of the day, the biggest thing here is, take no greater risk than is required to accomplish your objectives, right? If your objective is to have a $10,000 engagement ring or $20,000 engagement ring, put it in a high yield savings. If you're not getting married anytime soon, maybe you could be a little bit more aggressive. But just in that general sense, we see people ask this question around home down payments, around college, around buying cars. Is there something we can do to make more money? And it's like, look, it's not. If you're doing this in the next year or two, it's never about making more money. It's just about preserving the purchasing power you already have, supplementing it a little bit at best, and then trying to make sure that we get across the finish line at the time we expected to, as opposed to taking Hail Mary bets. Because then all we end up with is either more money earlier that's not necessarily going to get put to use in any more effective of a way, or we end up with less money and now we can't do the thing we were planning on. So hedge your risks, and more importantly, pick your risks.
Sweet. Appreciate it, Dan.
The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.